Hey everyone, it is Monday, 8 a.m. Pacific, and that means our expert series of the week kicks off, and we always bring Greg Dickerson to the show to kick us off. How you doing, Greg?
I am doing great, Michael. How are you?
I'm doing very well. Still shelter in place.
Hey,
It's
man.
seventh week, eighth week now. It's getting a little bit long in the tooth for me, I tell you.
Yeah, we're 8 weeks in Virginia, and I think you started on your own 2 weeks before
Oh, so
me.
10 weeks
You
now.
guys
Oh,
were like, you know what, we're done.
yeah.
So yeah, you're about 10 to 12 weeks in, I think, and they still have not, opened us up to phase one yet. Where you can go back and get your hair cut, which
Yeah.
I really need to do that. And nail salons and bowling alleys. That's the first three that they want to get open.
Yeah, well, there you go. Yeah, so it's pretty interesting stuff going on. One thing
Yeah,
I know I wanted to talk about, I actually read a headline that I thought of you this morning. Um, I believe there's going to be a lot of opportunity to buy discounted notes, first or
yeah.
second, but probably first. And the reason I thought of you is because it's kind of in your sweet spot, given what I know about your background. So WeWork, which is a company that almost went public and now is very likely going to go bankrupt here in a minute. They have a
Mhm.
$240 million mortgage on an office building in San Francisco. I just read today that it's trading in the CMBS market at 73 cents on the dollar, which means that $240 million note is worth roughly $165 million in today's dollars.
Mhm.
And I suspect lots of significant buildings are going to be retraded, not in the market like you and I, or like my listeners think about the MLS and LoopNet and all of that. They're going to retrade in the bond market essentially at discounts. So I just thought I would ask you about that. What do you think? Is it a sign of things to come? How do you get connected with that? Just all of that. I read that. I'm like, I got to ask Greg about that.
Yeah, absolutely. So, we talked last week about, what happens when a CMBS loan goes into default. This is one of the things that can happen. The note can get traded before the property, ever actually goes into foreclosure and all that. So, discounted notes are a tricky business. Okay. So, number one, you got to understand, how this is done. Usually it's bought in bulk by the big equity outfits, hedge funds. They'll go in and buy, hundreds of millions to, potentially $1 billion worth of notes
Mm-hmm.
that have been packaged up into CMBS. So when you buy a non-performing note, the difference is between that and buying an asset. I like to buy assets, okay?
Mm-hmm.
After they've gone through the foreclosure process, then I know exactly what I've got, exactly what needs to be done, and exactly what it's worth. The problem with buying a note is you don't know what you're really buying. So what you just said, it's trading at 70 cents on the dollar. Okay, well, what does that really mean? Do you really know how much the building is worth? What kind of work does it need to be done? I mean, the elevators could need work. You have all the repurposing of the space. The
Mm-hmm.
building may be, deferred maintenance on a building like that could cost you,
Yeah.
tens of millions of dollars, depending on how long it's been, vacant and in default, and
Mm-hmm.
abandoned, if it is, those types of things. So there's a lot of things you got to take into consideration before you could really place a real value on the asset. So let's say it traded at 200 million, you can buy the note for 70 cents on the dollar. So that's 140 million. For all we know, the retail value could be 50. The
Yeah,
street
that's
value
true.
of that product could be 50 or 70. So when you buy a note, unless you understand and fully underwrite the underlying asset, you don't really know what you're buying. So that's
Mm-hmm.
number one. Number two, you buy that note, then you have to get it performing and or foreclose.
Yeah.
So you've now taken on the headache of the servicer. So understand in the CMBS world, what happens is money comes from life insurance, pension funds, investment funds, endowment funds, sovereign wealth funds. It comes at the institutional investor level where they give money to a fiduciary that is either a direct lender or a servicer that in turn lends that money out. They create the mortgage notes and all that. They lend the money out and they collect the payments, manage the asset in terms of the loan collections, insurance, taxes, all that. So you have to become a servicer, or you've got to hire a servicer to now get that note performing, work it out, or foreclose on the property. And you've got all the legal issues and headaches and costs associated with that. So the note business at a very high level requires a lot of expertise and an understanding of the underlying assets of that note.
Yeah. So really what I'm hearing you say is really buying a building or buying a note. The process is really the same. You have to be able to underwrite it. But when you buy a
Mm-hmm.
note, you assume other risks is what I hear you
Mm-hmm.
saying, right? Because you got to get it
Yeah,
performing, it's there. It could actually have liens, right? In theory, it could have liens,
right.
contractor liens, and all these other things that now they're your headache. Is that true?
Exactly. In terms of you owning the note, it's still the
Position, yeah.
underlying note guarantor, owner of the property. It's still really their issue in terms of lien problems and all that.
Yeah.
But in order for you to foreclose,
Correct.
then it becomes a process. It's not your problem. You just wipe it out in foreclosure. So
Right.
when you foreclose on a property, it wipes out all the liens. So except for taxes, in some states. So
Right.
That's the thing you got to watch out for there. The problem is you got to foreclose, and usually these notes are sold, in bulk in packages. So, sometimes you can pick and choose what you want. Sometimes you don't know what you're going to get. And this goes all the way down. So this can be first lien positions, first, mortgages, deeds of trust on commercial, residential, any property. It could be a second. It can be a third. It can be a credit line. So like if you have an unsecured or secured line of credit at your bank and it's non-performing, banks will sell those notes off. And then there's a collection agency that comes in, or an investor that then tries to get that note performing, so they're taking a risk. Now those sell off way cheaper than, real asset notes. So it works in a lot of, auto loans, it works in a lot of different sectors. Non-performing notes or non-performing notes, it could be anything.
Yeah, very, very cool. So I think this is just going to come out. I think it's going to be dominated probably in office and retail, certainly first, because I just keep reading. So first off, rent collection in multifamily has far exceeded every expectation I heard coming into April and May. And let's knock on wood for June and July. But I think retail and office are getting smoked. I mean, I saw somewhere where retail collections like mall tenants is under 30% for this month.
Oh yeah. Yeah. There's just nothing you can do, so we'll just have to see if and when people can reopen. What does the traffic look like at that point? Are they able to pay anything at all?
Yeah.
As they get reopened. So that's a big problem. But again, it's going to be kicked, the can's going to be kicked down the road, for a while. There's a lot of places that are announcing on a daily basis that they're not going to be able to reopen. They're not going to sustain if they do reopen.
Yeah.
So, so there's going to be a lot of that stuff out there. So it's a little too early. If you're a note investor, it's not time yet. You need to get to the end of this when you really know what's going on, and really understand again, what it is you're buying and how it works. Now, on that note, just like hostile takeovers. So there's a strategy in the note business where in good times people will go in and buy notes and then call the loan and then take the asset over when the borrower can't pay. So I know somebody who owned a bunch of hotels, and his notes were totally performing. The notes got sold, to another investor, and the notes had an expiration date on it. And, or so I can't even remember why or what happened, but they came in and just called the notes on these guys. They couldn't refinance them, took over all the assets, and got into the hotels for, pennies on the dollar.
Wow.
Totally performing note. They just bought them.
Wow.
So performing notes get sold all the time too. So understand, a lot of people think of commercial real estate and the safety of it because you can get what's called non-recourse loans. So understand when you close a mortgage, when you close a loan, whether it's commercial or residential, you're in technical default the day that you close. There's always some loophole, some fine print, some way that they could declare your loan in default from day one as soon as you close that loan for any number of reasons that makes you a target for somebody to come in and buy that note, take it over, call the note due if somebody takes it over. So you're always at risk. There is no such thing as no risk, non-recourse debt.
Yeah, and that's very commercial specific, right? Because that doesn't exist in residential, to my knowledge.
Well, if you read your loan documents, you will find a lot of ways where you could be called in technical default pretty quick because there's covenants and there's requirements in that loan. You have to keep a certain credit score, certain bank balance, certain, this, that, and the other. You know what I mean? So if you drill down deep into those loan documents, I guarantee you'll find out, dang,
something,
you're in technical default on something. You didn't even know it.
Well, I'm not going to read my loan docs. Those things are ugly.
But they could trigger that clause.
Oh, I understand.
Just like a due on sale clause.
Yeah, of course.
So just like insurance. Everybody says, oh, I don't mind, I don't put assets in LLCs because I have a great insurance policy. I'm not worried about it. If you read fine print on insurance policies, man, they've got ways of getting out of, defending you if somebody sues you for liability.
Yeah, for sure. So one of the things I know I'm going to be interested in today is after our Simon Properties reports. Obviously, Simon Properties is the big mall operator. I think that's pretty much what they've done historically. But when I think about that, I'm starting to see REITs get in trouble, right? REITs have been the answer for lots of real estate investors. who work full time and maybe it's their 401k, right? I knew that was an option when I had a 401k. I'm going to put it in a REIT was one of the options. And it just looks like the what was thought to be an uber safe place to play, REITs, not so much. Just curious what your thoughts are there.
Yeah, there's a lot of REITs preparing for bankruptcy. Simon is one of the largest mall owners in the country. I think they're preparing and laying the groundwork for a bankruptcy. Now, understand what bankruptcy is. It's protection. It's not necessarily going out of business insolvent. It's protection, right? Because they're laying the groundwork to pair off these assets and get rid of them. So I think, they are among a number of REITs out there that are setting the table for this. And, the other thing about REITs you got to understand, they're very highly leveraged. REITs are usually more highly leveraged than the average investor. So, when people think, it's like Wall Street, man. Everybody thinks Wall Street's safe. The market will come back. We were just joking before this, but serious. Friday, the market's up and they're like, hey, Wall Street, the stock market's up on, the economy reopening and all the hopes. And today it's down. Stock market's down on fears of the economy reopening. So it's like, are you kidding me? It's like shake the value. So I'm telling you, there's a handful of people that are trading money back and forth because they're getting it for free, that are controlling the volume of the stock market. And when you drill down and look at what's driving the values, it's about 4 or 5 different stocks with tech companies that are really driving the momentum of the market. And, if it wasn't for the Fed and all that, the market would be, who knows where it'd be right now. So, I'm glad it's up. I'm glad it's coming back. But I'm telling you, whoever's watching this, if we ever get back anywhere near where you were, get out, because it's not going to last. It can't sustain. We had a good 10-year run. So the argument is, what's going to stop another 10 years of this artificial inflation and the Fed pumping money in, that's propping it up. But man, some of that stuff has to come home to roost at some point, because the economy just is not going to just bam, here we are.
Yeah. Well, Treasury Secretary Mnuchin over the weekend was talking about the true unemployment rate being 25%. And a lot of his headlines from Sunday were darn right scary.
Yeah. Well, you and I talked about that, 3-4 weeks ago when the first big wave hit, that the real effective rate back then was probably 30%. When you count sole proprietors, self-employed, people that are underemployed, people that can't get through the system. I mean, still today, there's millions of people that still have not been able to even get through the system.
So sad.
Yeah. So it's a lot more than, it's probably closer to 30%, if you put the real hard numbers to it.
For sure. One of the things that I keep going back to when we talk about stock markets and commercial real estate and all of this is two of the legends in the space. And now when I say legends, some of the people hear old white guys, but whatever. Sam Zell and Warren Buffett, both have come out in the last 30 days and basically said, we're sitting tight. There's been no price discovery and no deals yet. And yet the stock market's already 60% up from the bottom. And Carnival Cruise just got an upgrade this morning. And I mean, it's just, the Great Recession was a 2-year journey to finding value. So to think that we found value in 8 weeks is foolish.
It's fake. It's artificial. It's pumped up by free money. It's pumped up by hedge funds. And, again, Friday, another headline, worst unemployment since the Depression. Market's up. It's like, let's celebrate. We just got the worst, unemployment numbers ever. So it's just silly. It's I used to call it legalized gambling. I don't even know that it's gambling now, because it's not gambling for them. It's rigged. It's fixed. There's a handful of people that are really controlling the shots there. They're sucking the retail investors in. They have everybody conditioned to think, oh, it'll come back. Don't get out. Don't
buy the dip. Buy the dip.
Buy the dip. Yeah. So, you're buying somebody else's garbage that's already overpriced, So anyway, we'll see where it goes. But Sam Zell, I love Sam Zell. He's awesome. He's the original syndicator. He invented that business, real estate syndication. If you read him and study his career, you can learn a ton from Sam Zell and apply it. He's done billions of dollars worth of stuff, but you can apply it to any level. And he's done it in business as well with companies, just like he has in real estate. So I'm a little Sam Zell. I've done a fraction of what he's done, but same kind of thing with companies and with real estate. So I've kind of followed his career. Obviously, Warren Buffett, unbelievable, over his 40, 50 years, however long it's been, compound interest, right? Just stay in the course, long-term investor, and just rolling dividends back in and compounding. It's amazing what he's been able to do. And it's not rocket science. He bought Coca-Cola, he bought Apple, he bought, insurance.
American Express. Yeah. Yeah.
Right.
Yeah. Yeah.
So it's pretty amazing, how he's the only one that's really been able to do that. That's what's really amazing. You would think, and I guess it's focus. If there's any lesson learned, it's focus, it's pick a system and work that system. Whereas the rest of us, we do a little this, do a little that, go here,
Amen. Yeah, that is so well said. I mean, the only thing I talk about when I talk to students is focus and consistent execution. I call it learn your market, which is what Sam Zell and Warren Buffett do. They learn their market, they stay in their lane, and when opportunities are there, they strike, and they're comfortable. Here's the deal. Warren Buffett and Sam Zell are comfortable doing nothing. Right? Most of us, we get a little scratch in our pocket. We want to freaking deploy it as soon as possible. And we're going to chase the carnival upgrade or whatever.
Mm-hmm.
And no, I'm telling you, being comfortable doing nothing, it's hard. We're not conditioned to do it, but the great ones, that's what they do. They don't do that.
So, it's diversification too, right? So we're taught diversification. You gotta have, all these different things. But, here's something that I want everybody to understand. And this is the big takeaway of today. Look at the titans of industry, Steve Jobs, Bill Gates, Warren Buffett, Mark Zuckerberg, Bezos, all of these people who have created incredible things in their industry. They really were focused on one thing. Now, within that one thing, they were, they did a couple of different things that were diversified.
Mm-hmm.
Richard Branson is probably the most, scattered of them all with all the different things that he does in terms of, but he's been very successful.
Yeah.
But at the end of the day, he focused on Virgin Brands. That was his
Virgin is his thing. Yep.
And then, exactly. So think about that. Think about the power of focus. Think about picking that one thing, I love the one rental at a time. It just plays into so many different things, right? You can take that one thing and go. I thought of you the other day. Somebody sent me an email. There's developers out there building subdivisions for rent, which has kind of been a little thing here or there, but now it's becoming more and more of a major thing. Entire subdivisions of, brand new, nice houses that are strictly for rent.
Yeah.
It can be done at any level. Focus is 100% the game. So pick something, get started, stay on it, blow it up, and, diversify within that one thing that's working, but stay focused. That's how the greats of our time, if you look at all of them, have pretty much created, their wealth and such huge businesses.
Yeah. One of the quotes that's attributed to Buffett, but I'm not sure he actually ever said it, that I frequently quote is, diversification is meant for the lazy investor. What he does is he puts all his eggs in one basket and he watches the freaking basket.
Right.
I'm like, yeah. And of course, the quote that I saw didn't say freaking. It said a bad word, which is why I don't think Buffett ever said it, because I've never heard him swear.
No, you won't hear Buffett do that. But I've seen that quote. The other quote I've seen is diversification is for people who don't know what they're doing.
Yeah.
And I'm telling you,
yeah.
I hear it in real estate syndication, right? There's people out there that are passive investors and their philosophy is, well, I'm going to throw, money into, 50 different syndicators and 50 different markets with 50 different things. So I'm safe. I'm like, okay.
Yeah. Well, I got to tell you, one of the reasons I'm convinced we're financially free today is because we didn't diversify. I used that quote for a decade because I kept getting asked, well, why are you staying in California? Why don't you go to Texas? Why don't you go to Nevada? Why don't you go to Tennessee? I'm like, no, I have this much time every day to work on my portfolio of rentals. And I have to do my day job, right? I got to be a rock star at my day job. I have this much time. I'm going to watch my freaking basket. I don't have time to take this and divide it in half. And no. Now there's exceptions to every rule. So there are people that are serial entrepreneurs that have been able to do well, in things. But again, if you take the best of the best, most of them had one thing, one theme, the billionaire level that they focused on. Donald Trump real estate. One of my mentors, Cal Turner Jr., was the grandson of the founder of Dollar General. And, that's all they did. That whole family, the Waltons, all they did, right? Yeah.
Colonel Sanders, after a point, Stuart Cathy with, Chick-fil-A, Ray Kroc with McDonald's. I mean, over and over and over, all these different examples. Then you look at like a Tillman Fertitta, right? So Tillman Fertitta, billionaire, people may or may not know him, but the $1 billion buyer on CNBC, his thing, what a lot of people will say, well, he's in casinos, he's in restaurants, and it's hospitality. His
Yep.
thing is hospitality. He started with restaurants. How do you scale a restaurant? You open a bunch and you open hotels. Hospitality. Hotels are, it's real estate with a retail component built in.
Yeah.
That's how that works. So, again, Marcus Lemonis, a lot of people see him doing a lot of things, but Camping World, that's been his thing. Camping World is what made him a billionaire. He focused 100% on, that niche. So, you can over and over and over, you can see it, how focus, is 100% of the game for these guys that are doing stuff at a high level. I wish I would have got that at a young age. I mean, one of the things I read, Rich Dad, Poor Dad, build businesses that generate cash flow to invest in other assets. So my philosophy is build a bunch of little businesses that generate a bunch of little income, versus pick one and blow it up,
Right. That's funny. Well, one thing I want to do as we wrap this one up is talk about just the economy. Cause I think this is, lots of people talk about V-shape, U-shape, L-shape, Nike swoosh, square root. I mean, all these freaking things. Where do you kind of see this economy as we kind of crack open different states and cities as we head into the end of the year? Let's just talk about 2020. Have you thought about that? What are you thinking? What are your thoughts?
Yeah. So first of all, nobody knows, so we're in an experiment. This is the great, not the Great Depression, this is the great experiment, of our lifetime. So we really don't know. So there's two conversations. One is the markets and one is the economy. Yeah. And there's a huge disconnect right now, as we've discussed. The markets, you've already seen a V-shape, right? Yeah. You've already seen it because that's the stock market. That's fake, it's artificial, and it's propped up by free money from the Fed. Yep. Now you have the real economy, what you and I live in every day when we go outside. And, that is a very different animal. The money that is in Wall Street has not reached Main Street yet, okay? Every American in this country has not been given $100,000 that made below $100,000. That's what's happened in Wall Street. These billion-dollar companies, these large banks have been given hundreds of billions of dollars to lever up into the market. That's why you're seeing that. That's what would need to happen on Main Street to see a V-shaped recovery. The Fed would have to say, anybody who's they would have to match everybody's annual salary. Right. That's what they would have to do. We're going to send you for free the equivalent of your annual salary to restart the economy. Get out there and spend it. Now, the problem with that is, even if they did that, let's say, Michael, you had $100,000 in savings, and during this time, you've burned through 30% of that. What are you going to do as soon as you go back to work? Save. You might play for a week or two, but you're going to build that savings back up before you go back to Europe, before you, take an expensive vacation, before you buy a new car, before you go buy, whatever. You're going to build that savings back up because guess what? This could and will happen again. Yeah. Everybody is telling us that this is just a precursor to what a real pandemic like we've seen before, like Ebola or the Spanish flu or something like that just kills people in 24 hours by the millions could happen. That this is just getting us ready. Now, I don't know, but the science is saying this isn't the only time this is going to happen, and this is a small scale of what could happen. Yeah. On our own path, you have to look at what's really going on. More people are getting out and about than I anticipated, going back, but even still, it's going to be limited capacity. There's not going to be huge events. There's not going to be, a lot of the big things that we saw before this shut down until the end of this year, sporting events, all that kind of stuff. I think it's going to be next year if we get a vaccine, if we get a treatment, and we can get to the other side of this before you see people coming back in mass, before you see global travel again on a recreational level, and before you see, people really comfortable once they've shored up their reserves again, getting back out and spending, extra money. Of course, there will be that, hibernation fever, cabin fever. People are going to get out and spend a bunch of money and do some things real quick. Yeah. Man, I ain't going back to the movies, and I used to go every week. I'm not going in there. I don't want to go out and eat in a restaurant where everybody's wearing masks, and all that. So, and I'm not flying to Europe because you can't. Yeah. So, so there's going to be a limited amount. So I think it's still a year, to 2 years before you see any real trajectory on the upward trend, assuming everything gets taken care of, vaccine treatment and all that. So I'd say, within 18 months to 2 years, we're going to see 90% of where we were. Yeah. Yeah. For me, this is, I like that great experiment. I hope that takes off because I haven't seen that. I haven't heard that before. I think that's a great quote. This is the great experiment. For me, it's about how does, and you're saying it, but I'll just put it in different words. The consumer changes. That's
because that's all I ever track is I try to figure out what's going on with the consumer and cost of capital. Those are the only two things I care about in mass. Why the consumer? Well, they're my great competitor, right? They're the person that can come in with 3.5% down and frankly overpay for what I want as a rental unit, right? That's who I compare with. And I think they're going to be impacted by this. Everything I read about the Great Depression is there were generations impacted by it. And we're only 3 months into this thing. And you're right, this could go on for 18 months, 24 months. And if that's true, the consumer will be impacted. We will become a nation of savers. If we go to become a nation of savers versus being a consumer-based economy, man, this is going to be a long road to hoe. Unemployment's going to stay above 10% for a long freaking time. It's going to be interesting to see what happens. But again, go back to Warren Buffett and Sam Zell. Doing nothing is okay. That's what I'm thinking.
Yeah. Yeah, you don't have to do anything. You know, there's plenty of time. We're not going anywhere. We still aren't through this yet. It's not over. Even when we're reopened, until we get to a point where, you know, we've got this thing under control, anything can and will happen. I mean, it could come back with a vengeance. Now, unfortunately, we have children, small children, preschool and elementary school age, that are being affected by this.
I heard that
formerly weren't and didn't think they could. So, gosh, hopefully we can get control of that, and that doesn't become a problem. If it starts affecting kids, this country's going to shut down quick. You know what I mean? That's going to be a whole different level.
Yeah, I mean, right or wrong, right? It's one thing when it impacts adults disproportionately, but yeah, you start impacting 5-year-olds. Oh, done.
Yeah. Now, that's to say, what does this look like and when opening up? So as we start to open back up again, you know, if we see, you know, resurgence and we see general controlled, you know, fatalities, I don't think you're going to see another shutdown. You know, if it's within a certain demographic and it's within control, you know, you might see isolated areas like New York City might do something, San Francisco might do something, but not the whole country. I don't think the population is going to tolerate that.
No,
but if
totally
it affects
agree.
children, I guarantee you they will.
Oh yeah, guaranteed. Yeah, I couldn't even imagine. All right, man. Well, let's, you know, this again has been always fun. I love talking to you weekly. Again, my takeaway from the week is the stock market's fake. It's a rigged casino. Warren Buffett, Sam Zell doing nothing. Buying notes is risky. It's just, there's so many opportunities coming. I'm very excited. But again, nothing wrong with doing nothing for the next couple of months.
It's the great experiment. What a title for today's show.
You got it, man. I'm going to make that the title, buddy. Thank you very much.
Awesome. See you, Michael.
Uh-huh.